Good afternoon. I'd like to welcome everybody to the CERS Investment Committee meeting for August the 28th. Ms. Sherry, do you mind to take the roll, please?
Oh, let's do the first. We need the legal public statement.
Yeah, no problem. This is a regular meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61-826 and may be viewed by the public at the Kentucky Public Pension Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. Connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
Okay. Thank you, Eric. Sherry, roll, please.
Yes, sir. Mr. Cheatham,
Here.
Dr. Hackbart, Dr. Milkman, Mr. O'Mara,
Here.
and Ms. Pendergrass.
Here.
Thank you.
Being a quorum present, we'll move forward. I understand there is no public comment. Is that correct, Sherry?
That is correct.
Okay. We'll move on into approval of minutes for the June 4th Investment Committee meeting. Are there any changes, additions, or deletions that need to be made?
Move approval.
Second.
A motion and a second to approve as presented. All in favor signify by saying aye.
Aye.
Aye. All opposed, nay. Ayes have it, minutes are approved as presented. Next item on the agenda is a approval of asset allocation ranges. I think everybody remembers we made some adjustments to the asset allocation at our previous meeting, and we wanted to implement some ranges around those targets. So I'm not sure who wants to speak to that first, whether that's Steve or Craig.
Craig is actually taking the meeting remotely, so I was going to speak to that, if you don't mind, Mr. Cheatham. And to Mr. Cheatham's point, we did approve a new strategic asset allocation earlier this year, and you can see those new targets listed on the left-hand side. And we have gone through and started doing some work on the IPS, and as part of that, we were updating the new range rebalancings, which you see in the minimum and maximum. And given the changes to the target asset allocation, we reviewed what the minimum and maximums were for the old policy. And for a vast majority of these, we have remained very consistent with how we looked at building the plus or minus minimum maximum ranges around each of these targets. There are a couple of asymmetrical bands around public equity and public fixed income, which really are there more as a means of risk management. You'll notice that the target is 45%. We'll allow that to go down 15%, but only up 10% to the maximum of 55%. Similarly, with core fixed income, we want to maintain a floor on core fixed income because that is your safety and your liquidity bucket. So we are letting that go down to 10%, but we'll allow it to run up to 20%. So those are really the only two significant asymmetrical bands around our new rebalancing ranges. But if anybody has any questions, I'd be happy to take them. What we're really looking for here is to get these approved as of July 1, 2024. So all of the third quarter asset allocation reporting will be based off of these new targets and new min maxes accordingly.
Ms. Pendergrass has her hand raised.
Okay. Go ahead, Ms. Betty.
I have a technical question first. What happens on the specialty credit portfolio when the Fed starts lowering interest rates in terms of yield and performance?
So as far as interest rates go, much of the private credit portion, those are floating rate loans, so the yield can start coming down on some of those. And then the other half of that, remember, are high yield fixed income loans, so those are not going to be floating. So you just have to remember that your specialty credit bucket is comprised of half public and half private.
And certainly, let's think about the inverse relationship between yields and prices. So the assets that we do own, if the yield environment goes down, the value of those assets go up.
Correct.
It's probably also worth pointing out, and Steve, you probably have a better number than I do. Your higher yield bonds typically will have a longer duration than the specialty credit. Is that correct with your portfolio?
Yeah, absolutely. The fixed rate bonds, especially that make up that public sector high yield, will have a much longer duration than what's in the specialty credit or in the leveraged loan universe as well. Obviously that's the base rate is an important component. That's one of the arguments we've made for why that asset class is very attractive, but there's also a significant spread component. So that's above and beyond what the base rate, whether it's, the old LIBOR or not now SOFR rates. So there is a spread component, which our expectation is, again, we're not headed back to a ZIRP world. We don't anticipate that anytime soon. I think we expect base rates to remain elevated from recent historical standards, and with the spread component in addition to the base rate, they're still going to remain an attractive asset class.
Can you give just I don't want to use the term hypothetical, probably more of a general average as to what the yield currently is on your private credit versus where it is on high yield bond, that spread difference?
Sure. And again, we tend to invest relatively conservatively in the private credit component. It's not, we don't look to overextend. It's a pretty broad asset class, but on average, we're looking at, a 300 basis point pickup relative to public high yield bonds or loan market.
Okay. I wanted to address that simply because as rates come down, just keep in mind that there is currently anyway, a 3% higher yield level on those private credit versus the high yield bonds. So we may not pick up as much capital appreciation as rates come down, particularly if they come down quickly, but we're getting paid through dividend and interest.
Yes, absolutely.
What if we have tighter ranges on the specialty credit?
The ranges won't impact your performance on those
Right, yeah.
assets. The ranges here are really more of a governance perspective to make sure that we are maintaining adequate exposure to the
How would it
particular
affect our options?
I'm sorry, say that again.
How would it affect our options for the portfolio?
If the ranges were tighter,
Yes.
it would essentially mean that staff would have to rebalance more often if there are swings in the market value of those assets. They would have to maintain a closer proximity to your target.
Or other assets, right? Because the public equities swing a lot. These aren't that liquid. So having a tighter range makes it even harder in that case, just like for private equity.
But we don't have a lot of flexibility to move out of specialty credit once we're there.
Well, remember, specialty credit for our portfolios, again, it's a broad category because it encompasses both public high yield bonds, public loans, as well as what we consider broadly private credit. So the mix is relatively 50-50 for the current portfolio. So there is a component of that portfolio that has flexibility as far as our ability to allocate or to change allocations. I think when we discuss the ranges with Wilshire and we go about work on what's setting the appropriate range, they framed it correctly. We want to kind of balance. We want the portfolios to perform in line with the work that's been done for setting those target allocations. We also want to minimize what I would call forced rebalancings, especially in illiquid markets. So when, we've been through that period where we see a denominator effect, right? And we'll talk about that a little bit in our allocation in the material that we have. You want to minimize kind of those times when you have forced liquidations in alternative asset classes. You also want to provide staff flexibility to allocate, to take advantage of either market dislocations, as we saw during COVID. We moved significant assets into public equities. When public equity saw a drawdown, we thought it was a really good opportunity to increase allocations in the asset class. We don't do that. We don't take large swings. I think these are pretty tight ranges for the most part. You won't see significant swings or bets being made by staff as far as allocating away from the targets. But I think we want to have sufficient flexibility to take advantage of opportunities, especially dislocations that we see in the market.
Steve, just for clarification for everybody, because I think it's something that gets lost in the shuffle, particularly as we talk about private credit. The maturity, private credit and private equity from a maturity or long-term perspective are not the same.
Not even close. That's a great point to make. I think private equity, as we see in the portfolio that we have, we have assets that are decades old, right? I mean, the final realization for a private equity portfolio can extend beyond 10 years. Private credit is a much shorter lifespan, duration. It's a constant reinvestment, realization, turnover in the portfolio. And that's, when we talk about duration, what's the tenor of those loans or the assets in that portfolio is a lot shorter. It's much more akin to kind of the public loan market than it is, a private equity portfolio. I think when we think about duration, right, public equities have the longest possible duration, right? They have kind of an infinite duration, whereas private equity, the realization, especially, there's going to be a component that is not realized for 10 plus years, like we said, and we see that in our current portfolio.
Private credit, you're typically looking at what, as far as your portfolio, 2 to 3 years?
2 to 3 years is very typical, and a lot of times you'll have realizations inside of that. I mean, the bulk of realizations occur even inside of what the stated maturity might be for the investments. Depending on the strategy, those are not intended to be long-term financing options for the entities that are borrowing the money. 2 to 3 years is very typical for stated maturity. Obviously, there are cases where there's going to be refinancings or certain things might occur that extend the assets, but the bulk of the assets are going to be realized in a pretty short window.
Would just point out too that the range as a percentage of the target is the tightest for specialty credit of all the asset classes. It's roughly in line with as Chris mentioned, we have a tighter upside bound and a tighter downside minimum on equity and core fixed income respectively. So at 20% of 20% plus or minus 4, that's pretty much the tightest range we have anywhere. So going any tighter than that, we think about these ranges. One of the ways we think about them is in relation to the target, and that's a pretty tight band relatively, that plus or minus 20%.
I noticed yesterday during the PPOB meeting, teachers retirement presented their ranges. They've got a little different categorization as far as their asset classes, but whether you're looking at their fixed income or what they can lump specialty credit in as far as alternative investment, their ranges are approximately 46% both ways in those asset classes. So, I was really interested in sitting down and comparing those numbers last night. Other than those particular areas, you look at fixed income and private equity and public equity and whatnot, we're very, very similar in ranges percentage-wise.
Yeah, I think as we discussed when we went through the targeting work, the asset allocation work, especially for core fixed income, I think, and as Wilshire mentioned, that the asymmetry there makes a lot of sense. We want to keep a floor. That's the ballast for the portfolio. I mean, that's the low risk portion of the portfolio. It also potentially provides liquidity. And the upside being larger than the tight end of the range makes a lot of sense. If we were to get really conservative in a portfolio, if at times of stress, the two areas where you would see potential increases would be cash and core fixed income, right? Those tend to be what we would consider the safe haven assets. So having a more room on the upside, I think, makes a lot of sense from managing the risk profile of the portfolios.
Anybody else have any questions? Bill, did you have anything?
No, I think it's all been addressed. I was looking to have addressed the wide band for core fixed income, and you all talked about that.
Okay. All right. While we're not, we're not voting on the new IPS, we did want to present these ranges and get those voted on just so that they're in place for compliance reasons. With that, I'll entertain a motion to accept the ranges as presented, I guess.
So moved.
Second.
Bill, seconded by Miss Betty. Any other questions for anybody? If not, all in favor signify by saying aye.
Aye.
All opposed? I think that was unanimous. I saw Bill and I may have forgot to vote, but I'm in favor. Okay. Any opposed? Hearing none. Steve, you've got your ranges to work with.
Thank you very much. Appreciate it.
Okay. With that, the next item on the agenda is Investment Office Fiscal Year Update. Steve?
Thank you. Before I get into kind of performance and allocation, I was going to have, although it already feels like a little bit of ancient history, I was going to have Wilshire provide a very brief overview of the economic conditions and markets as of the end of the fiscal year, and then we'll jump into quarterly and fiscal year performance.
Thanks, Steve. And to Steve's point, it does feel like we've had a year behind us since just a couple months ago. The markets have provided us a little bit of volatility and some communication from the Fed. And just reviewing back on second quarter, looking at public markets, relatively good as far as equity markets go. The second quarter produced a little over 3%, judging by the Wilshire 5000, FTSE Russell 5. I'm sorry. The Wilshire 5000, and that brought us up to over 13% for the year. But that breadth and depth of the performers in the market was really kind of limited to the technology sector. That was really driving the performance for the 5000, where many of the other sectors were still negative. Some of the largest drawdowns were from materials, down just about 5.5%, and industrials down just over 3%. And we saw small caps continue to underperform large cap, with small cap being down just over 4% and large cap being up about 4.5% for roughly an 850 basis point spread. And we kind of saw that continuing theme of growth stocks continuing to outperform over value stocks, much of which, as we talked about, things have changed just more recently. We're seeing some of that drawback where small caps are starting to outperform, value is starting to outperform. So we're seeing a little bit of that kind of correction, if you will, leading into the third quarter. Yields obviously were a big topic during the second quarter. When we saw rises in 2022, we'll go into that in a little bit more detail here in a second. But in non-US equity markets, we saw what appears to be Europe coming out of a mild recession, and fixed income, the treasury yield curve was up across most of the maturity spectrum. The 10-year treasury yield ended at about 4.4%, which was up about 20 basis points. And yield spreads started to come up a little bit as well. And we started to get some messaging from Chair Powell that we have a very strong economy, but we want to be very conservative, and we want to make sure that we're seeing the appropriate data before we start cutting interest rates. And we'll talk about that interest rate cut here in just a couple slides. Sherry, if we could move down to slide 4. Looking at the rate environment, and really here the next slide, please, Sherry. The rate environment, you can see these orange lines relatively just moving to the right. While there was a little bit of up and down throughout the second quarter, nominal rates did end just right around 4.3%, and the break even and the real stayed relatively consistent. The break even inflation did move up a little bit and came down below, but ultimately ended up very close to where it started the second quarter, with real returns ending up slightly for the second quarter. We go to the next slide and we look at the Fed funds market expectations. And if you look at that top chart with the black line, that is the Fed funds rate, where you can see the last raise was in July of 23, right at 5.25%. And we've got different market expectations. The blue line is the December 2024 implied market rates, where you can see the market is expecting rates to be just under 5% by the end of the year. And if we look down to the bottom graph, you can see how the market has changed their expectation of how rates were going to be cut over the year, over the first couple of quarters, where in January, market was pricing in somewhere in the neighborhood of 6 cuts. Through communication from the Fed and expectations, we can see now that the market is really pricing in 2 cuts by the end of the year. We move to the next slide. This slide really addresses kind of the dual mandate that the Fed has been working towards, which is really looking at, number one, the price stability or inflation. And that blue line is measuring core inflation, which is really the stripping out of the food and the energy. And you can see back in the shaded area where you start to see those lines go up back in early 2022, that was the beginning of the tightening cycle. So we can see that since the Fed has started increasing interest rates, that inflation really has been on a downward trend. And while they're not at their target 2% level, they are moving in the right direction. And that does appear to be coming more under control. The maximum employment, or full employment, if you will, thinking about 4% being really what we would consider to be full employment, has really, the job market has been very resilient. We haven't seen a huge increase in unemployment. This has actually been a very good job by the Fed, keeping employment right around that 4% level while bringing the inflation down during this tightening cycle. If we move to slide 8, and this slide was put together by our CIO, and he likes to pull some music quotes every now and then. So he was inspired by Pink on this one, and he called it, not broken, just bent, which is really looking at the Sham rule here, which looks at the rolling 3-year unemployment compared to the low point of the last 12 months. And if that signal ends up to be 0.5% or greater, it's indicative of we're entering a recession. And so you can see where those green bars do move up above 0.5%, where the kind of recession ended up happening. We are at that 0.4% level right now. Not that we're calling for a recession or anything like that, but this is kind of one of those indicators that we started looking at, whether we are, in a recessionary environment or maybe a slower growth environment. And if you go back to just most recently in Jackson Hole, I think Chair Powell really confirmed that this is a time that we should look to start cutting rates now. So we are seeing some of that easing on the interest rate policy that the Fed is looking at.
And that rule is very similar to the inverted yield curve. There have been period of times when it's a good predictor, but confidence level in its ability to predict. I think in the current environment, this time it is different. Everybody says that. I think we have some unique circumstances, so I wouldn't necessarily read that just because one indicator is ticking that we're signaling a recession, that we're necessarily advocating that's the path we're going to take.
Absolutely. And I think that goes back to the, we're not in a recession. We're not calling for it. It's not broken. We're just seeing that there's a flag there to be aware of. If we move to the next slide and we look at what we're charting here is the year-over-year deficit or debt that the federal government has, which has reached $35 trillion now. And we can see, obviously, in 2020 and on, as the Fed was pumping more money into the environment, into the marketplace, obviously, we racked up quite a bit more debt there. But you can see how the total public debt has increased quite a bit over the year. And Chair Powell really, made the comment that the current debt isn't necessarily unsustainable, but the path that we're on is unsustainable. So this is kind of getting to the next job or the next balance act that the Fed is going to have to do is really managing federal and fiscal and monetary policy going forward. If we go down to slide 18, to touch on that fiscal and monetary policy just a little bit more, what we've done here is chart slide 18. Up a couple more, I think, Sherry. Or do we have the numbers off here? Up a couple more. Keep going up. There we go. So what we're plotting here is, you can see in the blue line, that is the federal government national defense spending. And you can see the interest on government debt, which has really taken off most recently here since 2020. And that interest on federal debt has essentially doubled from over 500 million to just over $1 trillion now, which is now equal to the amount of money that we are spending on the national defense program. I see Ms. Pendergrass has her hand up.
Will that interest decline if the Fed lowers rates?
They will have the ability to refinance in sorts some of the most recently issued debt. So yes, some of it will come off the books, but it's not going to mean that all of it will. If we go down to slide 23 as a quick review of market returns, we can see here again, just over 3% for the Wilshire 5000. And you can see that disparity between large cap and small cap that I talked about. Again, going down a couple lines, seeing large growth outperforming at 9.7%, while large value is down negative 0.8%. So quite the disparity between growth and value, not quite as pronounced in the small cap space, but obviously that makes up a much smaller component of the overall US equity market. If we go down to the sector weights and returns, again, you can see information technology was really the leader for the quarter, with communication services and utilities also providing strong performance, while industrials and materials were really the major detractors during the quarter.
Thanks, Lyle. I needed that.
If we go down to slide 28, moving into non-US equity markets, we will see here that the ACWI ex-US returned 1.2% for the quarter, so just a little bit over 2% under US equity markets, but as a little bit of a reversion from what we had seen historically or in most recent periods. The developed markets are underperforming emerging markets, with strong performance from the emerging markets at just over 5%. Japan and France were really the detractors from a regional perspective. And the UK and Switzerland were the top two contributors. And then looking at the emerging market top contributors, it was China, Taiwan, and India leading the way, with Brazil and Saudi Arabia being the two largest detractors. In fixed income, things were relatively muted here. You can see on slide 29, Sherry. We can see that over the quarter, the Bloomberg aggregate returned 10 basis points, 0.1%. Corporate just under, really kind of the opposite, down 10 basis points. Really where you can see the most movement is in the long-term side. Those various different styles, government credit, treasury down anywhere from 1% to 2%. And the tips and the high yield were actually pretty strong performers at just about 1% each. If we look down at the current yield curve, you can see the 6/30 2024 line as the dark blue line, whereas the 3/31 2024 is the light blue line. You can see that yields were up slightly during the time, but we still do have that inverted yield curve that Steve mentioned before. Moving down to slide 34, just to give you a brief overview of real assets. Overall, real assets did have a good quarter, with tips being up 80 basis points, commodities up almost 3%, and gold up almost 5%. The largest kind of struggles, if you will, were in the global resi index, and Odyssey's properties were challenged during the quarter. But other real asset areas, timberland, infrastructure, and energy all have solid performance of anywhere from 1% to 5.5%. Moving on to slide 35, I'll just touch base here. Looking at a year to date through second quarter, you can see that we are still being driven by global equity markets, US equity being the top returner at over 13.5%, T-bills giving us just over 1.3% for the year, and then commodities, at the bottom at negative 2.5%. But the key takeaway here is we still are in a very equity market-led environment. With that, I'll hand it over to Steve.
I've got a question or two on this page.
Sure.
What would we look for in the economy that would take that U.S. equity performance of 14.4 down to around 7% over a 10-year period in the next 10 years, 5 years?
Don't have the math behind what that would take to get to that level of return, but I can get back to you if you'd like me to calculate what type of drawdown in equity markets it would take to get down to.
And then a similar question on the high yield. What would happen in the economy that would take that yield up to 7.5? Because the projections in the asset allocation discussion indicated that the U.S. equity market would be half that, and the high yield would double.
Right.
Again, those expectations are prospective. So, we have embedded a starting point bias, right? Evaluation bias to any of those asset classes. So high yield, what would take the expected return over the coming 10 years to the level that we saw in the asset class expectations really is that base effect. So where we are from a yield perspective, and the expectation of that rates are going to remain very different than they were over the last 5 years.
And I'd also add to that, we're in a fairly tight credit spread scenario right now. So if spreads were to widen a bit, that could also be an enhancement for high yield.
Sure.
And as Steve mentioned, the inversion relationship between price and interest rates. As interest rates come down, your high yield investments should technically have a price appreciation there.
We also have floors. We also have floors for some of the specialty credit, which isn't coming into play now, and maybe not even as interest rates fall, but not all the way to zero. So those, like they were saying earlier, well, with the spreads that they're earning over regular fixed income, it's still likely to be an attractive return.
Any other questions?
Did you have anything else? Okay, all right.
With that, I'll turn it over to Steve.
Jerry, could you move to 37, please? And I would say that I think Wilshire did a great job, and this is something you're going to hear kind of a theme that's going to run throughout the presentation, and Joe's actually going to provide additional detail on it. But it was a good year, 12-month period, good quarter, especially for risk assets and for public equities especially. But it was really a challenging market for active investment management, as well as asset owners that had more of a diversified mandate. And that was really the result of that narrow breadth that Wilshire talked about for public equity markets. And when we look at The contribution to performance over the last 12 months, especially in U.S. Public equities, that was the mega cap growth. The AI stocks contributed about 70% of the overall performance of the index in a very few handful of stocks. So when you have that lack of breadth in the market, it's very difficult for active managers to outperform. It's also more difficult for asset owners with a diversified mandate to outperform. And we're going to see that come through in a number of different numbers we're going to present here. But the portfolios closed out the fiscal year with positive performance in the final quarter. Both the CRS pension composite and the CRS insurance composite produced a return of 1.32 for the quarter compared to the benchmark return of 2.74. For the fiscal year, the CRS pension composite produced a return of 11.63, while the CRS insurance composite produced a return of 11.76, both versus the benchmark return of 14.10. The start of the new fiscal year, as Wilshire alluded to, initially saw a significant pickup in volatility across markets, driven by a barrage of economic data and geopolitical news, with a weak U.S. jobs report fueling recession fears among certain investors. A sell-off in that U.S. technology stocks, which had really been the market leaders, led to a rotation, at least for a period of time, from growth into value, with small caps significantly outperforming large caps. 10-year U.S. yields fell to their lowest level since February on signs of cooling U.S. economic data and renewed expectation that the Fed was going to cut rates. Subsequent to that, so that was a very short window period of time as far as markets are concerned. Economic data turned during the month, with PPI and CPI prints bolstering confidence that Fed soft landing scenario was actually going to work out, and that caused recession fears to subside and supported a rebound in risk assets. For the month, U.S. and global equities were up modestly, while core fixed income outperformed on the back of falling yields. While the commodity index posted negative performance for the month, it was driven by sharp drop in oil, real estate, infrastructure, and gold, all posted strong performance for the month. I think we just released July performance. It was just finalized and released this morning. And the portfolios are off to a strong start for the new fiscal year, are up between 162 and 167 basis points for the month, outperforming their benchmark by 65 basis points. And as we'll talk about in a minute, notably the public equity portfolio outperformed during the month, making up some of the ground that was lost in the prior quarter, returning 2.33% for the month compared to the benchmark return of 1.61%. So a strong month for our public equity portfolio, and again, clawing back some of the ground that was lost in the prior quarter. So far in August, public equity markets are relatively flat for the month, which is going to point towards muted performance for the portfolios. Leading indicators are signaling economic deterioration, with payroll revision showing weakness in the labor market. Following Jackson Hole, as Wilshire alluded to, the looming question has become not whether the Fed will cut rates, but how quickly and by how much. The markets, as Wilshire pointed out, at the end of the second quarter, the final quarter of the fiscal year, we're expecting about 50 basis points of cutting by the end of the calendar year. Current market pricing is for about 100 basis points of cuts prior to the end of the calendar year, which we still view as overly aggressive. I think the Fed is focused on jobs right now. As Wilshire said, that the inflation fight, while maybe not completely over, a lot of ground has been gained there, and I think the shift of the focus is on the jobs market. Given the elevated uncertainty, what we view is slightly stretched valuations and potential headwinds, geopolitical, political. We continue to adopt a conservative posture and take opportunities to reduce risks in the portfolio. Sherry, could you go to page 42, please?
I've got a question before we leave this page, please.
Absolutely.
We have other tables that show us how returns are affected by asset allocations. This
Yes.
asset class section is the total portfolio. So how much of the performance is how is performance affected by the different asset allocations in KRS and SPRS that differ from the asset allocations that we have for CERS?
Well, so broadly, we will get into specific performance attribution for the C portfolios, but the driver of differences between, as you saw or may have seen, the KRS non-hazardous, hazardous, and SBRS portfolios didn't produce as strong a performance during the fiscal year, and that was primarily due to their lower allocation to public equities. With public equities being the best performing asset class within the portfolios in the market over the last 12 months.
Yeah.
But
How
sorry.
close are we to getting this asset allocation report to a position where we can see the CERS asset allocation and performance over this time period? I know we're missing some data for the out years because we couldn't get it from the previous custodian, but
So
are we making any
will,
progress?
yeah, we will dive into. So we have the separation of the reporting, and that was for the annual reporting, and that's asset class level performance by fund or plan. Whether or not how much we can go back and decompose the historical performance, but we will be able to report, because you're right. This is both of this, the pension and the insurance reported here are at the trust level, and individual plan performance by asset class will vary slightly, less so at an absolute level on the public equity. So for the public equities, those are managed fairly in line from an underlying allocation perspective. So all of the public equity portfolios across all of the funds or plans will have very similar performance at the highest level. So for the fiscal year, across plans, they all had about 17% performance. Now, their contribution to overall return varies because they have different allocations to public equities. So obviously, the C plans had a higher contribution to overall performance from that public equity portfolio because they had a larger allocation. But we will be able to provide a kind of a drill down into individual fund or plan asset class level performance. That's being done. It's being done for this annual report, and whether we can go back in history or not. When we also look at we dig into the attribution, that may answer some of your questions, specifically, not in a comparison to the K plans, but specifically as to what the drivers of performance for the C plans was. So as we get that, please ask questions.
Well, this report, because it is issued monthly, is extremely helpful for monitoring during the year. So I just think it would be helpful to have this asset class performance for just the CERS assets. And even if we start with, okay, we've generated a year's worth of history, and then 2 years from now we'll have 3 years worth of history, so that we could grow this table out, would be helpful. So it
Sure, I think that's something we can look to implement in the monthly reporting.
Yeah, one of the things that one of the responsibilities we were given as a separate governance board was to manage the assets. So this level of performance on a regular basis is really important, but we can't right now. We can't see the CERS performance.
I certainly think that's something we can implement. I'll come back to you with what it may look like, but we're happy to try. Sherry, page 42, please. Thank you. Following comments and questions at recent investment committee meetings, we've included some additional detail that highlights the performance of the internally managed passive portfolios. And this is really pulling out information that is available in other sections of the report. So something that we do report at every investment committee meeting. Despite the recent elevated market volatility, these portfolios have performed in line with expectations, providing the funds with low cost beta exposure to the more efficient markets. specifically on the public equity side. Joe's going to add some additional color here in a little bit. But I would note for this report, this is, as Betty points out, this is done at the trust level. So all of these numbers are trust levels. And you'll, on the broader report, which is back on page 82, you may notice a few additional line items noted internal. And these are internally managed proxy portfolios where the CERS funds currently do not have exposure. And additionally on this report, that total amounts, the percentage exposure amount is reported at the trust level, as I mentioned. So it's not for the individual CERS plans, but the performance numbers won't change at the portfolio level. The exposures will differ based on individual allocations. No questions there. Sherry, can we jump to page 62, please? I'm going to hop around a little bit here. I apologize, but I want to get into, I think one of the most interesting parts is the attribution. So we have attribution here that Wilshire provides on a quarterly and annual basis. On 62 here, we see the attribution, performance attribution for the last quarter. Across the portfolios, the largest contributor to relative outperformance was the strong performance in the specialty credit allocation, which outperformed the benchmark by 122 basis points. Within that allocation, 14 of the 17 portfolios outperformed the overall blended benchmark. So it wasn't an individual portfolio or manager that did well. They did well across the board, which was very good news. The most significant detractors, and you're going to hear this theme a lot, of relative performance during the quarter were the public equity and private equity portfolios. While the public equity portfolio produced a return of 1.36 for the quarter, it trailed the benchmark by 151 basis points. And that was driven by allocation and style biases. And as we discussed, that mega cap growth stocks continued to dominate market performance. The private equity portfolio underperformed its stated benchmark by 11.09% during the quarter, with the underperformance attributable to that mismatch with the public markets benchmark, which has been exacerbated in recent quarters. The underweight allocation to private equity is also shown as a detractor to relative performance. But again, that's driven by the mismatch of actual realized private equity performance versus the public markets benchmark. For the quarter, underperformance in the public equity allocation on average contributed about 80 basis points of underperformance relative to the overall benchmark, while that underperformance in the private equity allocation was responsible for 70 basis points of underperformance relative to the benchmark. So those accounted for the vast majority of underperformance relative to the benchmark, with just the underperformance in those two asset classes. Page 66. Looking at performance attribution for the full year, the most significant drivers of performance relative to the benchmark were the public and private equity allocations driven by the same factors I just mentioned. The private equity portfolio's underperformance relative to its public market benchmark, which is again that Russell 3000 plus 3% lagged one quarter, was responsible for between 200 and 250 basis points of underperformance at the plan level, as the private equity portfolio underperformed this benchmark by over 28.5% for the year. As we've discussed at previous meetings, private equity is a notoriously difficult asset class to benchmark and can vary widely by performance, can vary widely by strategy and vintage. But for the year, the range for private equity performance was roughly 4 to 8%. So our portfolios performed in line broadly with actual private equity performance, obviously underperforming that public equity benchmark significantly. The public equity portfolio produced a return of 17.01% for the year, but trailed the benchmark by 237 basis points, again, as it failed to keep pace with the rally in the broader public equity markets, driven significantly by those handful of mega cap technology stocks. This underperformance resulted in 115 to 120 basis points of underperformance relative to the benchmark for the year. For the fiscal year, the core fixed income, specialty credit, and real return portfolios were the standout performers, outpacing their benchmarks by 246 basis points, 109 and 794 basis points respectively. The underweight to real estate, which was the only asset class with negative performance for the year, also bolstered relative performance. I would note that all asset classes except those talked about, public equity and private equity, outperformed their respective benchmark for the year. And Joe and Anthony, as I mentioned, are going to provide additional color on performance and positioning for the public equity and private equity portfolios. So if there's no questions, I'll toss it to page 43 and Joe.
Good afternoon. Appreciate the time. I feel kind of like a dead horse just after that one where Steve was kicking me a whole lot, but nowhere to really hide. The public equity efforts in the portfolio struggled during the 12 months. There's no denying that. I think Chris and Steve both covered markets pretty well, but before we get into ourselves specifically, I think I'd just quickly touch on that. U.S. markets were strong, providing strong absolute performance of about 23% on the year. You see that in the top right, the blue bar, that's the Russell 3000. Growth outpaced value. Those are in those green style indices about by 20%. So significant outperformance by growth names. Large caps roughly doubled up their mid cap and small cap counterparts. Those are in those gray indices there. The market was very narrow. You've heard both Chris and Steve mention that. It was driven by mega cap tech. Basically, that drove 70% of the market's performance. And if you were diversified at all, it was very difficult to keep up with. It was difficult on our active managers who guidelines I dictate they have to be diversified to a certain extent. They weren't able to hold anywhere near the amount of Apple or Microsoft or Nvidia that the indexes did. And so it became a bit of a headwind, especially in that last quarter of the fiscal year. But market concentrations have reached record levels. Historically, this has been mean reverting, meaning when cap weighted indices significantly outperform equal weighted ones, you'll tend to see a reversal where those equal weights start to outperform, pointing to a broadening of the market. So we're hopeful for that. But large caps currently sit at higher valuations than small caps. To a degree, that's justified by their earnings. However, the earnings gap between the two are forecasted to narrow. So when you take into account the level of concentration in the market, the fact that large caps are sitting at high valuations, the fact that earnings gap is projected to decrease, we kind of think that's going to point to a broadening of the market. And we saw a little bit of that in July already of this fiscal year, but that should be good for our portfolio. So continue moving to the international markets. Good absolute performance, about half of what domestics were, about 11.5% up. That's the blue bar on the left, bottom left. Emerging markets outperformed developed markets by about 1% or so. So those are kind of more the green versus the gray. Value outperformed growth, both in developed and emerging markets by about anywhere from 3 to 4%. Large caps outperform small caps by about 4% as well in the international markets. The recent market appreciation there was more of a function, about half and half of multiple expansion, but also some earnings. However, it was still a difficult environment for our active managers where the correlation between earnings and actual stock price performance still relatively low in terms of kind of historical norms. However, it was improving kind of in the last quarter or so of the fiscal year. So we're hopeful that some of those active managers will be able to add value going forward. And again, July, we had a pretty good month. So hopefully that will continue. Sheriff, if you don't mind shifting to the next page. This is our portfolio specifically. And what you'll see here is Steve kind of gave you the highlight real quick. Good absolute performance of 17%. However, in the context of a benchmark of 19.4, it's disappointing to me. We'll get into why that occurred. When you look at kind of more from a regional perspective, our U.S. portfolio did fairly well, returning 22 versus 23. The non-U.S. portfolio just under 10 versus about 11.5. And some of the issues of underperformance occurred within the individual strategies. However, a good portion of it was just from our tilts within the portfolio. So at the beginning of the fiscal year, we were tilted a little bit more aggressively international. That was a function of it being a more attractive space from a valuation perspective, given the current market. It wasn't rewarded, obviously. We still maintain that tilt, but we've acknowledged and come to realization that the market doesn't agree with us at the moment. So through a little bit of rebalancing, a little bit of market movement of its own, that tilt is less aggressive today than it was at the beginning of the fiscal year. So we've taken some steps to kind of mitigate that to a degree. If you look at the right side, that pie chart, that is a strategy mix of your public equity exposures, starting at 12 o'clock Westfield and kind of moving clockwise all the way over to Next Century. Those are your domestic oriented strategies. Westfield and River Road are all cap managers. Westfield tends to be a little bit larger cap. It's growth oriented. River Road a little bit more medium or mid to small. Got a value tilt to it. The internal S&P 500 account, that's just a passive replicating large cap portfolio. Whether we manage $1 million there or 10 billion, it's no additional work on staff because it is a fully replicating portfolio. It's just a matter of the size of the account itself. The internal equity account, you saw it kind of labeled as scientific beta a few slides back that Steve pointed to. That's kind of a source of weakness for the fiscal year, and we'll get into it specifically here in a minute. The internal mid-cap portfolio, Northern Trust small cap, that's a core quantitative strategy. Next Century is a microcap growth product that we've added fairly recently. And then starting with BlackRock all the way to Pzena, that's your international focus strategy. BlackRock there is a passive developed market core product. It's an efficient way, relatively cheaply, to get exposure. But then we've kind of put some satellite positions around that with American Century through LSV. Those are concentrated versions that of products that invest in both developed and emerging markets, particularly more in the large to mid cap space, although Franklin Templeton has a little bit of a smaller feel to it. They were hired as a basket of managers to outperform the index in concert, meaning that we are very aware that at any given time, one or two or three of those may be underperforming. And we hope that, the next time we take a look at it, some of those leaders have reversed so that they work in tandem well together. So American Century is a growth product that's an inflection story. Franklin Templeton's a little bit smaller, more aggressive growth. Lazard's a relative value. LSV would be a quantitative, deep value, contrarian type of play. Axiom's relatively new to the portfolio. That's going to be an international small cap, both developed and emerging markets. And then JP Morgan and Pzena, also relatively new to the portfolio. Those are dedicated emerging market mandates, JP Morgan being growth and Pzena value. So that's kind of how the portfolio is positioned, the strategies that we employ. Sherry, if you'll move over one more, please. So this is the kind of talking about the attribution of the portfolio itself on the U.S. side. If you look at the bottom left, really performance of the individual mandates were pretty solid, with 5 out of the 7 outperforming. You see that with Westfield, River Road, the internal large cap portfolio did well, or S&P 500 did well. Internal mid cap did well. Northern Trust small cap did well. The internal large cap is a factor-based portfolio. It invests in an S&P 500 indice, but it does so tilting certain factors which were not rewarded. And we'll talk about that specifically. But top right is an aggregate exposure of all of our strategies in the U.S. Kind of rolled up. And what you see there is we're a little bit smaller. We don't have quite as much large cap in favor. 2/3 of that underweight is found in the mid cap space. And then in the balance of that in small, micro, and a little bit of cash. And that's going to be a result really of this internal equity portfolio that we'll talk about in a minute. But as you see, we had a market cap bias headwind in that we didn't have as much large cap in the portfolio. At the same time, we don't necessarily tilt value, but we do have a little less growth in the portfolio in favor of core, just when you roll things up. And if you'll recall from slide one, growth outperformed value by about 20%, meaning growth outperformed core by roughly 10. So we had both market cap and style headwinds to fight against this 12-month period. If you go to bottom right, internal equity, that's the one that probably catches people's eye. It's poorly benchmarked. That's my fault, and I have to live with that. It is a factor-based portfolio that is managed against a index that's provided by Scientific Beta. It plays in the large cap space, but it plays very low in the market capper. So it looks very mid-cappy. It tilts value fairly sharply. And so when you have periods when both large caps and growth outperform, and large really being defined by mega caps, it has significant headwinds to go against. And so it was less about poor stock selection and more about allocation and factor tilts that really hurt that portfolio. So as you see, significantly lower weight to those mega cap names, about 42% less in favor of the smaller portion. For instance, an example, the S&P 5 has Apple at roughly, I don't know, we'll call it 6.5% weight. This portfolio has it about 70 basis points. And so it's the same story across Microsoft, NVIDIA, all those names that really drove the market this year. It was significantly underweight. So it performed as it should, given the biases it has. However, those were not rewarded. And so that's the story of the underperformance there for that 12-month period. Next Century, you'll see that down there in the call out. It had a 5% relative underperformance. It's a microcap strategy. It's not a huge piece of our portfolio, though, of course, it happened to fall in the 12 months that we had some issues elsewhere. So just to compound those, that was a story of it doesn't have a lot of exposure to biotechs or GLP-1s. Healthcare is a big part of that index. And so there were some headwinds there. We've had this in the portfolio nearly 5 years. It's returned annually a little over 20% versus an index of 5. So it's done 4 times its benchmark, just happened to have an ugly 12-month that fell in this year. So that no real concerns there, but just felt like we should mention that was one of the sources of weakness on that part of the portfolio. If you'll slide one more, Sherry. So non-US side of the portfolio, if you look to the top right, that's our strategy mix there. You'll see the just under 10 versus the 11.5. A lot of that was driven from the growth side of the portfolio. So you'll see the call outs. Unfortunately, American Century, Franklin Templeton, JP Morgan in particular, they struggled. That's going to be primarily a story of exposure. And so I guess we'll just get straight into that bottom left, American Century. You'll see less about market cap and more about style. Growth, heavy in growth, light in value. And if you recall from earlier, international markets was an inverse of the domestic. So value outperformed growth by about 4%. So there was a style headwind for them. Franklin Templeton, the market cap bias of really being smaller. So you'll see there no real large cap exposure to speak of versus the index anyway in relative terms. A lot more mid cap and small cap. That was a headwind for the portfolio. The growth value bias was even more pronounced in Franklin Templeton versus American Century. So it had both those working against it. It also had some stock selection missteps. They missed the GLP-1 trade. They also didn't have any exposure to Taiwan Semiconductor. This is the AI craze of NVIDIA. Taiwan Semi is their supplier. And so while they did have chip makers in the portfolio, they didn't have this one. And this one significantly outperformed everybody else. And so there were some missteps there. And then JP Morgan, it's less about market cap and more about that growth bias in the portfolio being a headwind. They also, if you recall, I think Chris mentioned India being one of the better performing regions during the year. They didn't have a lot of exposure to India. It's not because they don't like it. They're long India, but they don't like the valuations currently. And so currently they're short from a tactical perspective, and that weighed on the portfolio as well. So this the international portfolio was primarily an exposure issue. We anticipate, in a market like this, our growth managers to underperform. We anticipate our value to outperform. The value, for the most part, did their job. LSV and Pazina, there you see outperformance. However, to the degree of underperformance, they did not work as the ballast that we would have liked typically. And so that's kind of the issue there. To put a bow on things, from an absolute perspective, 17 is a good number. From a relative, down 240 basis, not good. We are aware of some of the issues. Well, we're aware of the issues and we're addressing them. So like I said, some of those tilts we've kind of tactically taken down a little bit. The internal equity portfolio has been a bit of an issue for us for a while. We're running a search right now to replace that. Wilshire and I are working together on that, and we've received some R5 responses that we're supposed to be reading. So we have, Chris, several hundred pages to read. So I'm excited about it, but we're going to talk about that in a couple of weeks, is what we can do to implement some changes there. On the non-US side, not real concerned from what's in the portfolio. However, when some of these headwinds become tailwinds, if the portfolios don't respond the way they should, we'll have discussions on whether those individual portfolios need to be part of this roster or not. And I would point out, in July, there has been a broadening of the market. The performance has improved significantly. So that 2.4% underperformance for that fiscal year period, if you were to roll that forward 1 month, that's been cut in half. August continues to look pretty good from a relative perspective for most of our managers. And so things are going better than they were. This is a bad snapshot for us, to be real honest, but happy to discuss or take questions if anybody has anything.
And just to highlight that narrowness or lack of breadth in the market, looking at, say, the ACWI over the first 6 months of the calendar year, up about 10%. There's an alternative, it's called an equally weighted index. If you look at an equally weighted index that doesn't consider cap size, it's flat. So there's a big divergence, and I don't think Wilshire can weigh in as well, but this is not unique to CERS. I read the press releases from other public plans, from other foundations and investors, and underperformance relative to public equity benchmarks has been a pretty consistent theme. And again, a large part of that has to do with, we seek to build resilient, diversified portfolios without significant concentration. And in a market like the one we saw over the last 12 months, it's just going to be difficult to keep up with those types of markets.
Steve, I'll just add to that. That's so true. We do see that across the board with public equity portfolios. And in particular, I'll take the US side of that. I just took a look at where the index ranked, meaning the FT Wilshire 5000, in a universe of US equity portfolios. So not managers, but asset class composites, just like you're managing there in Kentucky. And the trailing 1 year, the index has outperformed to 86% of all of those portfolios around the country. So it's just been a tough attempt. We know what it is. It's driven by a handful of names, and same problems that active managers would be having in that space. So are asset owners in managing portfolios.
And to the point Joe made about diversified portfolios, a lot of these active managers, they simply cannot hold the same weights of those Mag 7s. While it's hurt them right now, if there is a deepening of the market and it kind of, the breadth kind of spans out a little bit, you should see active management come back pretty nicely there.
Thanks, guys, and thank you, Joe. Great job. With that, if there's not any questions, I'll turn it over to Anthony, who's going to discuss kind of the situation in private equity in our portfolio. And I think that's on page 47, please.
Yep. Thanks, Jerry. Hi, everybody. Yeah, like Joe was saying, I think for comparisons, endpoints really matter for public equity, of course, and obviously for private equity as well. especially because these are such long-lived assets and just don't move around as much as as public equity do, either up or down. So this slide shows that it was a news story in Bloomberg not too long ago about how private equity returns lag the public markets, mainly because, as we've been discussing for quite a while now, the public markets basically have gone up a lot in recent quarters. So the private equity marks just don't usually keep up that way, and especially in a time like the past year or so where transaction volume has just gone down a lot. So that's what that shows, but it's not terribly meaningful because it's just too short of a time period to really say much. So we'll go to the next slide. Page 48, this is one slide that I think Wilshire made, and we'll have another one later about just the difficulty of benchmarking private investments. I think we've had some questions and comments about how to benchmark private equity. It's a difficult thing to do. Public index plus a premium is, as you can see, it's easily available. And obviously it shows, what you could be doing with your money if you didn't go into private equity, but obviously it's not investable, and volatile markets, either up or down, really just kind of distort it into something that's not super meaningful. So we can go to the next page. So speaking of not being meaningful, you can see some of the large divergences here. Basically, the blue bars and the red bars just show when the equity markets in red go up or down a lot. The private equity returns are just not going to go up or down as much, and so the numbers look big and look like they should be saying something, but they kind of don't. And for the shorter time frame is what this is saying. So, and then overall, this is kind of what the portfolio has been like in rolling 10-year returns on slide 50. If you go to the next one, sorry, I didn't see it, Sherry. So that's more of what it looks like to show, what the performance can be like over longer periods of time. So again, against the equity markets, it can swing wildly, either underperforming or overperforming. And then slide 51, if you look at that one, that's against more of a private equity benchmark. So it's also going to be similarly less volatile, and just going along with kind of how the marks and progressions occur for different funds. If you go to page 52, this is a slide that Wilshire it shows kind of the partnerships that have been committed to over the years by KRS and how they've done against funds from that point in time. With the, obviously every year it's going to have different market conditions and setups. So overall, the program's been quite good, preceding all of this, because these take a long time. And like Steve said, there are a couple investments we have that are old enough to drink. They are more than 20 years old. So it can take a while for some things to fully liquidate. If you go to slide 53, this is going to start talking about a little bit about why the performance looks so different against benchmark of late. For some historical context, you can see here, this is not identical to CERS, but for the K plans, which were less well funded, they just couldn't do private equity for several years because of the illiquidity and their need to pay benefits and meet liquidity needs. So locking it up for 10 plus years was just not really a prudent thing to do. So there's several years where those plans missed out, and so that can lead to some of the different performances among underlying plans. And then another thing that also, when we compare our private benchmarks to the current public markets, a lot of these assets are old. So and then if you see that I put down 60% of the pension assets and 45, almost half of the insurance assets are 10 plus years old. And if you flip back, Sherry, to 52, you can see the 2015 and 16 vintages are coming up, and so those are about to expire as well. So some of those are also, becoming older, and they are just not going to move as much as the public benchmarks are. We can go to page 54 next. So this is the pension side. You'll see the insurance side next. They both basically say the same thing. If you just look at a year and a half ago, end of 2022, and you saw the 1-year performance for private equity versus the benchmark, it was outperformed by almost 15% or 1,500 basis points. And then now versus today, where the past year it's lagged by almost 2,900 basis points. These are most of the same funds. So it's 8 out of 10 are the same in this slide, and 9 out of 10 the next slide. they're still basically the same investments. They just have been held for a little longer. But you know, if you look at one, it would say that private equity was basically the rock star of the portfolio, holding things up from in 4Q22, and then net today, it looks like the hugest drag ever. They're kind of still the same investments. It's difficult to compare it that way to a public benchmark, especially over just 1 year. So you can see what I'm talking about. Same thing for slide 55. Same thing, a lot of similar managers. Most of them actually done pretty well. It's just that when you compare them over 1 year to a benchmark that's up 30%, it's just not going to match that. And then last slide, I think here is on benchmarking. So again, going to the difficulty of it. These are what some other, I think, kind of best in class or well-regarded funds have done as well. So state of Wisconsin, they have kind of a complicated benchmark here, 5 different components to kind of match some of the different things that they put into their private equity and debt portfolios. Virginia has a custom one. As you can see, it has 75% North America, 20% Europe, 5% Asia. I mean, those are, that's supposed to reflect kind of the opportunity set there. And teachers just does kind of like what we do, like S&P plus 3%. So, I mean, there's different ways to do it. They can all tell you, help triangulate on how your portfolio has done in terms of a quick and easier, relatively easy analysis, but there is no standard way. These aren't investable. And so it kind of just has to go at a deeper level if you really want to dig into how the whole portfolio is done. It's kind of fund by fund and vintage. It takes a little more than just comparing one number versus another a lot of times. So I'm happy to take any questions if people have any or offline, but yeah.
Thank you, Anthony. The one thing I would highlight is prior to the last iteration of the IPS, that teachers approach we had a very similar approach in that for periods inside of 5 years, the performance benchmark was the actual performance of our private equity portfolio. And what that really tended to do, as Anthony spoke to, is it tends to minimize some of the volatility, again, short-term performance with what is deemed to be a very long-term asset class. And then for 5 years and beyond, we use what we're currently using, which is the Russell 3 plus 3% lagged 1 quarter, which is really, in my view, more of an objective of a program. So over the life of the program, that's what we hope to achieve. We hope that once the full realization of the assets, we look back and what was the return on those assets. Our objective is to achieve what the investable alternative, which is public equity. Is there an instrument that gives us public equity plus 3%? No. That's not investable, as Anthony points out, but that's our goal or our objective for the program. So that's where we tend to view how is the program done, how are we relative to our performance objectives.
Yeah, you just wave goodbye.
I'll just add that these are conversations that we're having with many of our clients right now, and I think it's a healthy conversation to have because private equity benchmarking is not a perfect world. There is no beta that you can just go out and buy in the market to get. So we are left with these quote unquote imperfect indexes, and they can range from what you see on the screen here, which is a public equity plus a premium, to some type of a universe benchmark, and there's various different ones out in the marketplace. But I just wanted to reiterate, this is a conversation we're having with many of our clients that do use this public equity plus a premium benchmark.
It seems to me like we've got to at least visit what we're using to benchmark. I know there may be some drastic changes in 12-month cycles, but we ought to at least find something that is somewhat comparable when you look at a 3 or 5 or 10-year cycle. Otherwise, it throws all to me. Turns into a wild card as far as your assumptions, which leads me into 2 other questions. One I probably should have asked earlier. When do you all anticipate coming out with your next version of your forward-looking capital assumptions?
We do that at the. Go ahead, Chris. Sorry.
I was going to say we do that on a quarterly basis. So we do have 630 assumptions, which I'm happy to share with the group. But we'll next month, obviously get new updated market data points that we'll plug into our models, and they will spit those out, and we'll have them in early October.
Okay. Yeah, if you don't mind emailing out or getting out the second quarter version.
Happy to.
Something that well, look, before I get off subject, anybody have any questions on anything either Steve or Wilshire put forward?
I will just say, Mr. Cheatham, that on slide 3, we do have our updated June capital market assumptions. So those are available for you right there. If you need any more detail, please let me know.
That's the problem with, I've got to rely on what you all are putting up on the screen. I can't bring up my board books and I need a third screen to do that. But I did see them in there, but earlier, but I'd like to go back and compare them against, what we used to set our asset allocation. But I think I had mentioned
slide 10 of the PDF.
To you and David at one point in time, something that I'd like to see the investment committee get out of you all. Probably not at the next, certainly not at a special call meeting, but at the next regular meeting is an overview of Wilshire and your services and what we're contracted for, what we're making use of, what we may not be making use of, that sort of thing. So I'd really like to see that on your all's agenda.
We'd be happy to do that.
We can do that.
Okay. Bill, Betty, do either of you all have any questions? If not, I think that's the last item of our agenda, unless you all have something else you want to bring up. I got a thumbs up there. Okay. Well, with that, I want to thank all of you for your time and effort, and I thought the material was really good, and look forward to our next conversation. Meeting's adjourned.
Thank you very much.
Thanks all.
Thank you.